Let me ask you a question. If an invoice appears in your GSTR 2B, can you safely claim input tax credit? Most traders say yes. But what if I tell you that this single mistake can lead to interest, penalties, and departmental notices even after 3-4 years? And thousands of small traders are unknowingly doing this mistake every single month. Stay with me till the end because I will also explain what the GST department can do when they detect this mistake later. The real situation traders face. Let me explain a very common real life scenario. Suppose you purchase goods from another state, let's say Gurgaon. You are in Bangalore. Example timeline I'll give you. 30th March, supplier raises invoice from Gurgaon. Goods transported from another state basically. But because of transport timing, goods reach your shop only on 5th April. Now, something interesting happens. The supplier uploads the invoice on March GSTR 1 and the invoice appears in your GSTR 2B on 14th April. The three critical dates every trader must understand. This is where most mistakes happen. There are three different dates involved here. First one is supplier invoice date. Supplier issues invoice on 30th March. Actual receipt date, this is the second date. Goods reaches your premises on 5th of April. Third date, GSTR 2B reflection. Invoice appears in GSTR 2B on 14th of April. Now, tell me honestly, what do most traders do? They see the invoice in 2B and claim ITC for month of March. And that is where the problem starts. What the GST law actually says, section 16(2) of the CGST Act is very clear. ITC can be claimed only after the recipient receives the goods or services. So, in this example, invoice date is March, goods received date is April. Therefore, ITC cannot be claimed in March. That is in April. You cannot claim, even though the invoice belongs to March. Very important. Even bigger issue in import purchases. This mistake becomes even more dangerous in import transactions. In imports, goods may arrive in India. That is one scenario. Custom clearance may take some more time. Bill of entry may be generated later. But many businesses simply claim ITC based on accounting entry or portal data. Remember, for imports, bill of entry and actual receipt of goods becomes critical for ITC eligibility. If goods are not received or accounted properly, ITC claim may still become legally questionable. What happens when the department detects this? Now comes the most important part. GST assessment and audits usually happens 3-4 years later. When the officer verify the record, they compare invoice date, transport documents, e-way bill, goods inward register, stock records. These are the points they'll examine. If they find ITC claimed before the receipt of goods, they may treat it as ineligible ITC. And then the consequences can be reversal of ITC, interest on the date of wrong claim, penalty proceedings. Imagine this happening after 4 years. Interest alone can become very large. I want to ask you something. If the department detects this mistake after 3-4 years, do you think they will impose only ITC reversal? ITC reversal plus interest? ITC reversal plus interest plus penalty? Write your answer in the comments. I will explain the correct legal position in the next video. The 3-month ITC timeline is very important here. In interstate purchases, there can be 3-stage timeline. I'm repeating it again. First one is month on which invoice raised, that is in March. Let's say month 2, that is goods received in April. Month 3, return filed in May, 14th of May. So the correct ITC claim happens only in May for the month of April. Okay? But many traders wrongly claim ITC for the month of March. Why traders make this mistake? Let's understand. This happens because business rely too much on GST portal data. The common mistakes are blindly following GSTR 2B, purchase entries only based on invoice date, no goods invoice register, no tracking of transport dates, no coordination between accounts and stores. These are the points. The real solution, most important advice is The GST portal is only a reporting system. It is not your accounting system. Businesses must maintain proper books of account. Every trader should maintain purchase register, goods invoice register, transport delivery proof, stock records, import documentation. Only then ITC eligibility can be safely determined. Let us see the step-by-step method to avoid this problem. Follow this simple system. Step 1. Record invoice entry in accounts. Step 2. Record actual goods receipt date separately. Step 3. Verify e-way bill or transport document. Step 4. Allow ITC only after goods receipt. Step 5. Very important. Then match this with GST Act 2B. So remember this very important rule. Just because an invoice appears in GST Act 2B, it does not automatically mean ITC is allowed. Under GST law, again I am repeating, receipt of goods is the key condition. If businesses rely only on the portal instead of proper accounting, it can create serious tax exposure in the future. Before you leave your answer, let me ask you, if this mistake is detected after 4 years, should the department charge penalty or interest? Please mention in the comment box. If you want, I will also explain 5 hidden GST mistakes that trigger notices for small traders. Let me know in the comment. Thank you. Bye-bye.